We're joined now by Brian Hartigan, Invesco's global head of ETFs and index investment. Invesco manages the QQQ, the fund that tracks the Nasdaq-100. Brian, great to have you with us.
Great. Thanks for having me.
And we were just talking about how it's changed so much in the 40-year period. And the most remarkable change, not just the size, is a concentration, right, these days.
That's right. Yeah, it's really evolved since 40 years ago, the index launched, 25 years ago, QQQ launched. Really, as I say, one of the leaders of the ETF industry. But you've seen that concentration evolve over time. But what's been true is the index has always captured the secular themes, be it technology, innovation. We talk about the beginning of the internet days into PC computing, into tablets and smartphones, onto social media and into AI and the like. So the index has always been able to capture the leaders of that. But this year, you're certainly seeing much more concentration in the top holdings, and that's been a big story around the markets this year.
Hey, Brian, yeah, congratulations, because you know, ubiquity sometimes is a negative. You've achieved ubiquity. I mean, the association of the Qs to the markets is, as we were saying, like Kleenex to facial tissue. Right. So good for you. And I guess the RSP is outperformed this year. And so after years of, you know, I was probably saying 1 year ago, I don't think 6 stocks are going to be 30% of the S&P or 36% of the Nasdaq. So just give us your thoughts on the flows there. And I'm curious now just to layer in the institutional versus retail, because institutions, it's no longer an embarrassing thing to, as a hedge fund guy, to say I'm owning ETFs.
That's right.
You know, and especially these ETFs, which give you a lot of balance.
Right. Well, we talk about Qs. Qs is one of the most liquid vehicles in the world. RSP has actually taken on the same institutional liquidity. You know, it's fractions of the S&P, and it's multiples of what it used to be in terms of the liquidity. So it does bring in institutional investors to do exactly what it does and diversify from that concentration risk. So equal weight, the 500, you're taking away the Mag 7 and some of that concentration, and you're able to really, you know, surgically insert kind of that allocation, whether it be short-term, long-term, or for your overall portfolio diversification. So we're seeing the institutional adoption, and again, that much more close, hands-on surgical precision that investors are looking for.
Brian, give the viewer a sense. Like 2 years ago, NVIDIA was a $300 billion market cap company. Now it's a $3 trillion market cap company. How do you guys, you know, kind of rebalance these sorts of ETFs so you don't get too lopsided towards some different, a few different names?
Sure. Yeah, the NVIDIA story is an amazing growth story, and the index captures that, right? Whether it's we have index evolutions from the mid-cap, the next 100, into the ultimate Nasdaq-100, and those rules really create some of the ceilings, right, for diversification rules, minimizing some of the 5% allocations that you have. So the indexing really takes the rebalancing, the management kind of keeps buying some of those winners and gets rid of the losers very naturally through the index process. So.